But let's just rewind the clock back and look at what happened yesterday, right? I mean, so that's also the big one, which is the flows picture, the big selling that we saw. Hormaz has put together some data. Hormaz, take it away.
One of the biggest factors for the sell-off that we saw on Thursday was this relentless selling that is coming in from the FIIs over the last 3 sessions, almost $3 billion, and almost $2 billion of that came in yesterday's trading session. 15,243 crore in the cash market is where the FII selling figure was, but almost all of it was concentrated into 5 large cap names, and the index heavyweights dominate that. Look at Reliance Industries, HDFC Bank, ICICI, Axis, Tata Motors, all of them cornering a large share of that focused FII selling that we saw in yesterday's trading session. Now, yesterday's selling was also the highest that you have seen from foreign institutions in the last 4 years. That is almost dating back to the COVID period is where you have seen this kind of selling from the FIIs. And if you could look at the data as well from this year, where you have seen the first 2 figures coming from January this year, which is right before the budget, on the 4th of June, of course, which was the day of the Lok Sabha election results, and of course then towards the end of September, which is when the downfall actually started after the markets had made new highs. Now, where has this, but most of this selling is attributed to money moving out of India and going into China, but not everybody is convinced of this China rally, and Rajiv Jain of GQG is one of those, and he mentioned this, and he's been underweight on his funds in the Chinese markets, and he's mentioned this, that how many times in the last 3 years he's seen this excitement only to dissipate going forward. He calls this a trade, a very good trade, but if he says that if this party goes on without them, they're fine with that, but it's a trade and there's nothing more. Is this really that something can be invested in the next 3 to 5 years? But Citi has come out with a view. They're saying that this Chinese outperformance, this CSI 300 up almost 24% in the last 1 week, supportive policy announcements, and this rally has led to the Chinese markets catching up with the Indian markets over in terms of share, in terms of returns. And they also say that strong macro growth and outlook is going to be supportive for, and resilient domestic inflows will keep the Indian equity supportive as well. And Gavinkel Research has also come out with a view. They're saying that even if China continues to sustain its rally, they're saying that many foreign investors continue to remain reluctant to invest there, and the headwinds that China is facing will become a tailwind for the Indian markets. And the last caveat that they add is, while foreign investors can definitely find value in other emerging markets, it is too early to call time on India's bull market.
All right, Hormaz, thanks very much. And of course, as they say, the OG, Stanley Druckenmiller, speaking at a conference, this is the day before yesterday, also essentially said that when asked a question, I mean, it's also about what they're asked, right? And they respond. Essentially said that as long as President Xi in China is there, he's going to stay out. In that sense, echoing what Rajiv Jain of GQG said, happy to miss out. There are enough other opportunities. You can't be everywhere you cannot be, and perhaps should not be as well. So those are some views coming in. But that FII number also, the past large episodic outflows, as Hormaz pointed out, it's very large yesterday, but we've had these before as well, a few times this year.